All right, let's talk about one of the most anticipated market debuts of the year, the LG India IPO. You know that famous smiley face logo, right? Well, the story behind it actually reveals a ton about the Indian market itself.
And you're probably thinking, ugh, another IPO? Seriously? Haven't we had enough already? And you know what? I get it. We've all got a bit of IPO fatigue. It feels like a new company is hitting the market every other week.
But trust me, this one is different. This isn't some high-flying tech startup you've never heard of. We're talking about LG. If you grew up in an Indian home, you know that name. It's the logo on your fridge, your TV, your washing machine. It was just a part of life. And now, the company behind it all is going public.
So how exactly is this IPO structured? Well, it's a pure offer for sale, or OFS. What that means, in simple terms, is that LG India itself isn't raising any new money for its business. Instead, the Korean parent company is just selling off a part of its stake to the public.
And it's a massive sale we're talking about, valued at over 11,600 crore rupees. But to be crystal clear, not a single rupee of this is going back into the Indian company. The parent is essentially cashing out a piece of its investment after being in the country for nearly 3 decades.
Which, of course, brings us to the million-dollar question. If the company isn't raising funds for its own growth, why on earth would you go through all the hassle of an IPO? Well, the answer tells you everything you need to know about the India's story today.
It's all about the massive, untapped potential of the Indian consumer. The parent company believes LG India has become such a heavyweight, such a giant, that it deserves its own public valuation, completely separate from the global business.
Just to give you a taste, look at the air conditioner market. In just 5 years, it has more than doubled in size. That is absolutely explosive growth, and it's a trend we're seeing right across the board in consumer electronics. But here's the real story. Despite that boom, India still lags way behind other major economies in appliance ownership. Only about 35% of homes have a refrigerator. Just 22% have a washing machine. And you know what? That's not a weakness. For a company like LG, that is a massive runway for future growth.
And the company knows the big city markets are getting crowded. The real battleground, the next frontier for growth, is in India's smaller towns and cities. This is where rising incomes are creating a whole new generation of consumers who see these appliances not as luxuries, but as essentials.
So the opportunity is huge, but is LG actually built to capture it? Let's take a look inside the LG machine to really understand its operational power and scale.
Let's just run through some numbers to understand their sheer dominance. First up, their reach. LG has over 35,000 retail touchpoints across the country.
Then, after you buy, there's service. They run the country's largest after-sales network with over 1,000 service centers.
And finally, manufacturing. Their 2 plants can churn out a staggering 14.5 million products every single year, making them the largest in-house appliance manufacturer in India.
Now, a key part of their whole strategy is local sourcing. Over half of their raw materials now come from Indian suppliers, and that's a big deal. It means faster production, less dependence on imports, and a really strong Make in India story to tell.
Okay, the strategy is solid, the scale is impressive, but does the performance actually back it up? Let's look at the financial scorecard to see what's really under the hood.
So where does the money come from? Well, the business is dominated by the Home Appliances and Air Solutions division. Think fridges, washing machines, and ACs. That part of the business brings in a whopping 75% of the total revenue.
Now, let's talk about profitability. The profit after tax has climbed steadily, hitting over 2,200 crores in the last financial year. But even more impressive are these efficiency numbers, like return on equity and return on capital, which have jumped all the way to 45% and 47%. In plain English, that means the company is getting incredibly efficient at generating profits.
So with all this, how is it being priced in the IPO? Well, the company is asking for a price-to-earnings multiple of about 33 to 35. What's super interesting is that this is actually lower than the industry average of 43, which suggests the valuation might be pretty attractive for potential investors.
Of course, no investment is without risk. To get the complete picture, we have to read the fine print and really understand the potential challenges LG India is facing.
There are 4 key things to watch. First, nearly half of its raw materials are still imported, which makes it vulnerable to currency swings. Second, competition is fierce, especially in the big cities. Third,
Its entire business relies on a licensing deal with its Korean parent for the brand and the technology. And finally, there's a significant tax dispute hanging over the company that could really impact future profits if the verdict doesn't go their way.
So, after weighing this massive opportunity against the potential risks, what's the final takeaway on this IPO? Let's bring it all together.
And I think it comes down to this one crucial point. LG India isn't a startup asking for money to build some far-off dream. No, it's an established, profitable, market-leading company. It's inviting investors to value what it has already built over decades. They're selling a proven track record, not just a promise.
And that leaves us with the ultimate question. Fun fact, the name LG originally stood for Lucky Gold Star. Now the only thing left to see is whether that luck will extend to the new investors on Dalal Street. I guess only time will tell.